exclusively for any financial needs that our clients have. And so I'm going to turn it over to Glenn and let him get you going. Thanks for coming today. Appreciate it.
Thank you, Jed. Welcome to all of you here today. I'd like to start by saying I've never really had a meeting with a startup founder before 9 a.m. in the morning, so kudos to all of you for getting here early. Appreciate it. Thanks to Chad and Joyce and Orrick for sponsoring this meeting. I think that the whole purpose of us getting together here is for excellent people to come together and to create success for the common good for all of us. And that's what this meeting is about. The people who are going to be participating in this meeting and helping you guys out, there's something in it for them, but there's something in it for you. That's kind of the startup culture. That's why it works here in the Bay Area. And to a certain extent, that's true for our firm as well. My firm is staffed with about 50 senior level accountants and 20 CFOs, people like me. We're one of the fastest growing companies in the Silicon Valley. What we do is outsource financial services. So companies that are just getting going, you have limited resources, but you have financial reporting needs, you have AP, accounts payable, cash management, budgeting, these kinds of issues that are important for you and for your investors. We can come in and provide those level of services for as little as $500, $600 a month. So we just provide the level of service that you might need at the time that you need it. Beyond the basic accounting services that we provide, we also do tax and valuation services. So 409A, when you're issuing your stock options, we can talk to you about that as well. We've had over 300 companies that we've supported who have successfully funded themselves. And basically, we're here to help you achieve your success. So we're here to talk about building a financial plan. And in essence, the financial plan is just a tool that's going to help you communicate with investors and senior managers on your team. As Guy Kawasaki, who's famous here in the Valley for helping startups, your job is to create a numerical framework that complements and reinforces the vision that you've painted with words. So you're telling your elevator pitch, you're telling your story. People are going to want to know, how does that relate to dollars and cents? What's the market opportunity if I invest with you? What's the profit potential if I invest with you? That's the goal of you creating a financial plan. In terms of what we're going to talk about in today's presentation, the materials are in, the printed materials that I'm about to present are in your handouts, so you've already got it, don't need to take notes. We're going to spend about 25 minutes talking about the material, and then we'll leave a little time for questions if anybody's got something that we can help them with immediately. So the kinds of things that we're going to talk about in our presentation today are, what are investors looking for in your finances? When you present your plan, what are the kinds of things that these investors are going to be looking for? What are the key points that you need to provide in your presentation so that they can take away the information that they need to make a decision? What is a financial model? What are we talking about here? What's it going to look like? What are people expecting to see when you deliver them something? Then the goals and objectives. When we go through this process, what are we trying to achieve? Where are we going? What's it going to do for us? Is this just a mental exercise, or is there a purpose? Does it have value to us? Then we're going to get into some detailed issues, such as milestone funding. What is a milestone? What does it mean to raise money to achieve milestones? Why would I want to do it that way? Why is that something that investors are expecting me to present to them? We're going to talk about some, I know this is going to be the fun part of our presentations, the nitty-gritty accounting type stuff. What's a bottom-up financial projection? If you guys can stay with me through that, I'll be impressed. And part of that bottom-up is spend. What does it mean when I have limited finances that can only go out to a certain point in time? How do I manage that limited budget? And then something that is actually a verb, budgeting, as well as a noun, which is my budget. We're going to talk about that process, the verb of budgeting. What does it mean to go through that process? From a technical perspective, a budget is different than a projection. A budget is something that's static. You work on it, you put it in place, it really doesn't change over the course of the next year. You might reforecast it once, but it's for larger enterprises or more stable enterprises. As I'm sure most of you folks here are sitting there asking yourself, really, I'm going to project something for the next 12 months, I don't really know what's going to happen in the next 2 months. So that's where projections come in. Projections start the same way that a budget does, but there's much more interchangeability and variability with a projection. You might go back and look at a projection and revise your projection monthly, because the assumptions that you made on day 1 have changed greatly by day 30. We're going to talk about the difference between bottom up and top down, and what that means and why it has value for different people in different ways. We're going to talk about, as we go through this budgeting process, what kind of cost assumptions do we need to make, how do we go about building it, and then the concept that we just talked about in projecting is the reforecasting. What does it mean to go through an iteration of the budget process, and how do you do it? So why a 3-year financial model? It's a comprehensive financial picture that serves as a roadmap for your business. You want to give a sense of confidence to your investors. They want to look at you. One of the reasons why they like to invest in people who have been successful before is that they're investing in people, not just ideas. So if you've had a successful exit, you're more likely to get money from investors. Maybe investors that have been successful with you in the past, maybe ones that are sitting there going, this guy knows what it means. I can have confidence in him. That's basically what a financial model is helping to convey, that you're on top of things. You know how you're going to spend this money that they give to you. It helps you understand your cash burn. So if I raise $1 million and I think there's a key milestone that I need to achieve in that 12-month time frame, this is how much money I can spend every month. It helps you and forces you to evaluate key performance drivers. So as you go through this process, we'll talk about that later. As you go through this process, it's going to make you think through things. Okay, what's really important for me to accomplish for this company to be successful? It validates your assumptions. So as you're going out and talking to investors and you're telling them, hey, it's going to cost me this much to acquire my first enterprise reference account. Well, let's see how much it really did cost, right? And so if you put that plan into place, and then you compare that with what you actually achieved, you can help validate your assumptions. It puts challenges into perspective. So when you're thinking about how much it costs to accomplish something, the more something costs, the more important it better be to you. It's an iterative process that we talked about before. You can improve your assumptions over time based on actual experience. It gives you insight into your business model, so it helps you understand what are the most important priorities that I need to achieve. It clarifies your decision-making process. When you're in a startup, things are moving 1,000 miles an hour. You're trying to figure out which way is up. If you've got 20 different initiatives that you're trying to accomplish, you're likely going to fail on most of those. But if you can focus down into your 3 key ones, you're more likely to be successful. And then it gives you leverage on accurate baseline valuation. Valuation. Who here isn't scratching their head thinking, okay, what's my startup worth now? And what's somebody going to give me on a pre-money valuation? That's always a subjective discussion. It has all sorts of variables, depending on who you are, what the market size is, who your team is, but it also comes down to the finances. If you can present a very articulate vision of how big your company can be and how many milestones you've achieved, that can help your argument in terms of the valuation of your company. In terms of putting this being together, this financial model that we're talking about, in terms of putting it together, what we've kind of identified here are some key placeholders, and we wanted to put it in a visual like this so you can see that it's a continuum. It's a continuum of these are the elements that you're going to analyze and look at as you're putting the model together. These are the things that you need to be thinking about. You're going to have to take a guess at some of these things. You're not going to really know the answer to some of these things right now, but you should be thinking about it. You should be able to articulate to your investor where you are in the process of discovery of some of these things. To the extent that they know your business model and your metrics like cost of customer acquisition better than you do, that would not be a good thing. So you want to make sure that you identify what those key variables are, think them through, go outside and get other data points so that you can validate your assumptions and things like that. So as you go through here, obviously you're going to need to talk about what your major objectives are. Okay, this is our vision of who our company is. These are the things we need to accomplish to get to that point where we can start to achieve the first phase of our vision. Those things are usually called milestones. Most people, I'm sure, in this room are kind of familiar with that concept. If you're not, what it really means is I've achieved this objective, and it creates more certainty that my business model is likely to be successful. So an example of a milestone would be a beta of your first product or product launch. Is it something that can be put out to customers yet? If it is out to customers, are you starting to get traction with those customers? Do you actually have sales? So it depends on who you are as a business. You know, if you're B2B, if you're enterprise focused, if you're B2C, all of these kind of milestones are going to be different. But in essence, your investors are going to want to know how far along you are in the continuum of creating a real business. So once you understand what your milestones are, you're going to be going through identifying key assumptions. We'll talk about those further down the rest of the presentation. Once you have some idea of the future, you're going to be able to see trends. And the one trend that everybody here has heard about before is the hockey stick. If you want venture investors, you're going to want to be able to show a trend that leads to the hockey stick. Key variables, what are the things that are going to come into play as you move forward? How are things going to change over time? How are you anticipating what might change over time? And how are you going to deal with those variables? Timeline. How long is it going to take you to achieve everything that you're talking about? Be realistic. If you're in beta developing a big data solution that's going to have millions of dollars in sales on an average customer sale, and you're still at the formative stage, you're going to have to be realistic about how long it takes you to get to that beta where you can actually sign up a customer. And then it's going to cycle all the way through. This is going to be an iterative process, and you'll always be addressing these things at different times. So the major objectives of your company, this I think is fairly intuitive. On the one side, and not everybody here is the same. Not everybody is going to want to go after venture money. Some of you are going to have good business models that can be profitable early on and can generate positive cash flow early in your life cycle. Maybe going after angel money might be better because your market size isn't so large. But what you're going to do is think of who you are and where you are on this side. Are you going to go after venture funding? If you're going to go after venture funding and you're going to have negative cash flow, okay, where do I need to get to before I'm in a position where I can raise the next dollars? And it better be tagged to a milestone achievement where you can point and say, I told you I was going to get to this point, we are at this point, in fact, we're even farther than this point, and the money that we took from you at this point was enough to get us to this stage. Now, our valuation should be higher, and now this, according to our plan, is the dollars that we need. It's very different than if you're in a positive cash flow situation. You have a narrow market, and you want to expand that market, so you've got some profits that you can turn into going after new market share. Depending on where you're at, it's going to have an influence and impact on your business model. Okay, so we're going to talk about some nitty-gritty stuff here in terms of creating your financial model. How do you approach the process? So obviously, this depends on where you are in your business. If you, all by your lonesome, you've got an idea, you don't have much more than that, this process is going to be lean. You're not going to have people you're going to interact with. If you're a more stable organization, a little bit more established, and you've got other members on your executive team, think about what each of your roles are. Who is on the engineering side? Who is on the sales and marketing side? You probably don't have general and administrative staff. That's why people like us exist. You don't need to hire full-time people in that role. So are there other key players? And what's their role going to be in the organization? So once you define functional areas of responsibility, you're going to map that to spending targets. So you're going to go to members of your executive team, if there are such, and you're going to say, okay, what do we need to accomplish? What are our objectives? Remember, that goes back to our initial slide. What are we trying to achieve? What are our milestones? What do we need to do to get traction in the marketplace? Every company is going to have a different answer to those set of questions. You have to answer those questions specifically to your situation, where you are in your business, who you are as an individual, and what your team is comprised of, and what market are you going after. So once you define and identify what your objectives are, then you need to think about, okay, how is this going to roll out within our organization? How are we going to allocate budget dollars? We have zero money now. if we had, we're all working for sweat equity. If we had $1 million, what would we do with that $1 million? And then you start to identify, okay, based on our objectives, where are we going to allocate our limited resources? If you're in beta, maybe all the money goes to engineering. You have to think about, am I going to hire people? Am I going to be able to use programmers? Have I used programmers outside the U.S. in the past? How do I go about attracting that kind of talent? How do I go about vetting whether people are a good fit outside the U.S.? You have to think those things through. Then you're going to kind of pull all that information together. If it's just you pulling that information together. If you've got other people in your team, it's going to be other people on the team that you're going to be pulling together. Generally, people on the team are going to have a higher wish list than you're going to have resources. So there's going to be a trade-off. You're going to have to think about those priorities and those objectives. And you're going to have a give and take with these people in terms of really, do we have to hire people here in Silicon Valley? Can we potentially outsource it? That sort of thing. When are you going to go to market? How are you going to spend your marketing dollars? Let's say that you're a B2C and Google AdWords is the way that you're going to attract customers. What's your initial budget going to be? Is it something you're going to do monthly? Is it something you're going to try for 1 month and then see what you learn and come back to the drawing board and go out and spend money in future months? You got to think that thing through. You got to have the trade-offs. You got to figure out where the give and take is going to happen. And then this is going to get you to the nitty-gritty of building a budget or a projection, which is identifying the specific costs and when they're going to be spent. That's where the bottom-up approach comes in. So when we talk about a bottom-up financial projection, what we're really talking about is how do I build this account? Now, Excel is a tool that 100% of the people that I know use. So everybody in this room probably has some familiarity with that. But where do you start? So almost every budget starts with revenue projections. Even if your revenue projections are 0, that's where you start. And that'll be your top line. You may have different types of revenue. Then you go to the costs of revenue. You figure out what your specific costs are. Those are usually things that you can get your hands around. You may have to make some assumptions when you go through that process, such as what's it cost for me to acquire a customer. You may have to make some assumptions along those lines, especially in a B2C environment. If it goes all the way up to enterprise, you could have significant costs in trying to acquire customers, but you got to think those things through. So once you understand where your revenue numbers are, then you're going to be thinking about, okay, how do I figure out how much I need to spend to achieve either this revenue or this product development that I need to achieve? And we're going to talk in the next slide about where those cost categories are. And then lastly, and this is probably the most important area, most of our clients, their primary expenses in personnel costs. It's pretty obvious, right? Until you've got a full-blown business, most of what you're doing is getting people on board to build something that you can sell. So you're going to be looking at how many people do I need to hire, and what are we going to accomplish? What are the milestones that we're going to achieve once we hire this many people? So in terms of the concept of spend for bottom-up projections, what are we talking about here? Well, we're talking about these large placeholders. And we're thinking about the concept of what goes into each of these categories, and are they people, are they things, are they processes that I need to pay for? You're going to need to do some discovery. You're going to need to talk to other people you know in the startup community. Maybe you're housed at an incubator. You can ask some people around. Gartner is a great source for resources and information as well. You can go out to public company research, but that really isn't going to be that relevant for folks here. In terms of getting salary guides, salary.com can give you an idea about what it might cost to hire people. You can look at postings on Craigslist and things like that. So you're going to want to get some placeholders for these key areas. What's it going to cost me to acquire a customer? Human resources. If I hire people, what are the salary levels I'm going to have to hire? Do I have all the key members on my executive team? Well, if I need a head of sales, is it enterprise sales? If I'm going to be marketing on the internet, do I want to get a marketing director? How pricey does that marketing director need to be? Those kinds of things. One of the consultants and professional services, There, we can give you really good ideas. Probably the biggest expense in that area is attorneys when it comes to H-1B1 visas. That's an expensive process. In terms of fundraising, usually the attorneys will take their monies out of proceeds from the cash raise, so you're in a pretty good position there. In terms of other professionals such as ourselves or human resources, that's usually a fairly quantifiable number, so you can come up with that. Research and development, that can be your biggest bogey, the one that's going to be hardest for you to figure out. What kind of talent can I acquire? What's going to cost me to get them? Can I even attract them to my company? Am I going to have to offer benefits to get a full-time employee? What's that going to cost? Office and admin, you should be able to go out and see, okay, can I stay at an incubator for how long? If I hire a certain number of headcount, when am I going to have to move into rent and get office space? Am I going to do that in San Francisco, the Bay Area, somewhere else? What are rents going to cost, things like that. Sales and marketing, obviously we've talked about. Capital spending is probably the biggest bogey out there. Right now, you don't have to go out and buy room service anymore. Amazon Web Services, a lot of clients use that, so it's a more of a variable cost. But if you're in a capital-intensive business, you're going to have to plan for that as well. In terms of some nitty-gritty on budgeting, I think most investors want to see accrual-based financials. The difference between accrual-based and cash-based is revenue and expenses are recognized when earned and incurred on an accrual basis. On a cash basis is basically when money comes in and when money goes out. As a founder, you're going to want to know both. Cash burn is everything when you're getting started. So obviously cash-basis financials matter to you guys. But investors are looking over the long-term horizon. Venture investors have portfolio of companies and they accumulate all of their financial results, so they tend to look at the world in terms of an accrual basis because that's what all their portfolio companies are doing. They have to have a common language to be able to consolidate all their portfolio companies' results. So you're going to want to report your budget by department and major cost drivers. As we talked about, those departments, G&A, research and development, product development, sales and marketing. Plan actions. How quickly will this impact revenue? So if I'm going to do something, when am I going to see the results of those things? You got to think that through in your budget. Obviously, identify your key variables. If you're working with Excel, lots of times you can be changing your assumptions, and you can see how that rolls through your model. So, one of the things you're going to think about if you're in the internet space, direct to consumer, is what's my churn? How long do I retain customers? If I get somebody today, can I sell more product to him tomorrow? Those kinds of assumptions can be reflected in your revenue analysis, and as you learn more over time, you can tweak those assumptions. So you can run different scenarios. So if you're going through this whole budgeting exercise, we like to talk about things in terms of milestones I've referred to before. Talk about the concept of a milestone. It's really good in terms of so many different ways. One is it focuses your people internally. What do they need to accomplish? Where do they need to get to? It's a way to communicate to your investors that this is how close we are to achieving this significant event. It can tie into your valuation. So for so many reasons, milestone is really helpful. So when you do that, it's always easier to figure out what the short-term future looks like if you rely on the recent past. So that's always good. If you're running your financials and seeing how your recent past looks, you can tweak your current term horizon to get a sense of what it's going to look like in the near future. What do you need to accomplish before you run out of money? Every single one of our clients, that's where their mindset is at. What's my cash out date? Where am I at in terms of achieving my objectives? What's my cash out date? Do I need to be clever and creative in terms of raising capital between my next milestone that I'm going to achieve? That's where venture funding, venture debt funding comes in. That's where financing of receivables comes in, and things like that. Ask budget owners what they need to accomplish goals. So hold people accountable. You've gone through this exercise. They've told you how much money they need to get to where they need to go. Hold them accountable to achieving your objectives. And then we've talked about the trade-offs, the trending analysis, and the trending initiatives. Okay, now we've talked about how you're going to go about building your budget, building your projections. Typically, what we see is people will do it on a monthly basis, going forward for 36 months. You don't have to start in January. You can say month 1 and go out to month 36. You're going to put this in your slide, in your investor slide. So usually what we see is you'll see it collapsed in a quarterly presentation for the first 12 months. You'll see the second year just summarizes the second year, the third year summarizes the third year. That's your bottom up, and that's going to be one of your slides. However, since we're talking about communicating here, that's what this meeting is about, is communicating with investors and being relevant to your investors. Although we say here it's not particularly useful to talk about top-down, it's very useful when it talks about, is this service relevant to the venture investor? So I'm sure all of you know that venture investors are successful maybe 1 out of 10 times. They like to do a lot of seed investing. Seed investing is very popular these days. There's all sorts of different ways of doing it. One of the reasons is you can get a company off the ground and see whether they can achieve their first milestone or two with just $500,000 these days, maybe $1 million these days. So you can take $50 million and put it to work in a lot of different scenarios. But you need that one to be a home run. It needs to be a big market opportunity. That's where the top-down slide comes in useful, is that you start with the market size, okay? And you have to be realistic. You've got to know you're going to get a lot of questions and a lot of scrutiny around your assumptions here. So the more realistic and the more proven your assumptions can be, I've gone out and looked at a Gartner report, I've got these studies, these evaluations that support what I'm coming up with my market size. Great. The bigger the better, clearly, but within reason, it's going to be supportable. Then you identify your particular market segment. At this point, you can dream a little bit. We may know that you're going after a very narrow market today, but if we get there, this is the step we're going to take A, B, and C to expand our market. And by virtue of expanding our market, we're going to be bigger in terms of our segment. And then you extrapolate to your current total potential revenue. So what we're going to see is our company is going to achieve $1 billion in revenue. The market size is $50 billion. We're going to disrupt it to this extent so that we can capture this much of the segment, and that translates into $1 billion in revenue for our company in year 5. So in the last couple of minutes that we've got here, we're going to talk about the concept of reforecasting. So this presentation today has been primarily about communicating with investors. But where we live, in terms of how we work with our clients, we really look at projections as being a living, breathing document that helps a founder run their business. It helps them run their business because we put a lot of work into figuring out what these assumptions might be, what these drivers might be, and we're holding people accountable to these metrics and these drivers of value, and we want to learn from our experience. So we want to figure out, how do we want to change our assumptions over time? That's where reforecasting comes in. So first of all, we don't think it's valuable to use a 5-year plan. If you go to Guy Kawasaki's book, he says put a 5-year plan in there. I think once you get past 4 years, 3 years, people are realizing you're just guessing. So update your budget on at least a quarterly basis. Now this is not, it could be for investor purposes, because you've got better information. Don't have a stale pitch book. Make sure it's updated with current information. But also for your business and where you're running your business. It forces you as a founder to have some discipline in looking at your assumptions and thinking through how realistic you were and how those key assumptions may need to change. There may be a new set of metrics that you didn't even think about when you were first launching your business. And then for investors, almost all of our venture capital investors are asking for quarterly reports. So, the January, April, July timeframe, we're always very busy accumulating reports for our clients because they're going to roll information up for their portfolio companies so they can report out to their investors. So, you're always going to be doing that on a quarterly basis. And then, in terms of what's realistic, it depends on where you're at with your business. If you're in stealth mode and you're just doing development of software, it's not that important to revisit this thing on a monthly basis because nothing much is changing. If you're going direct to consumer, you're doing a lot of information gathering about what's successful from a marketing standpoint, client retention, client churn, things like that. You are going to want to go in monthly and update your assumptions because it's going to have a big impact on the bottom line and how things look at going for your next raise. So at this point, we've kind of finished the overall comments. I hope it's been somewhat valuable for you. You're probably not going to be able to walk out the door and start building a plan if you didn't have one earlier. That's the kind of thing that the CFOs on our team help clients with. It's something where you have to step back a bit to build something that can be useful. But if you can put it in place, I think you'll find that it's going to have a lot of value for you in communicating to your investors and helping you run your business. So thanks very much for your time. Any questions?
How do you like to draw boundaries for the top-down market sizing analysis? So there's always this balance I find of going too big and being too broad and too general versus being too granular and getting sucked into a rat hole. And that's something I've had a lot of trouble balancing. Do you have any advice around that area?
You're talking about investor?
Yeah.
Venture capital investing?
Exactly.
So I think the place to start is, what's the dollar revenue that's going to be of interest to a venture capitalist? So, depending on who you talk to, they're going to have their own different ideas of that. But let's say it's $1 million, right? So you can start there and work your way back. And then I think, because it's really an academic exercise, then if you know what your answers need to be, which of those placeholders can you support best? So if you know you need to get to $1 billion and you work your way back, let's say that you can get a 2% share of some market, then you know that the market size needs to be $50 billion. How do you define the market so that it's $50 billion? That's one way to approach it.
So if you don't reach $1 billion in 3 years, how do you show that your business potential is bigger? Let's say if you're focusing on a 3-year plan versus a 5-year plan, you might not hit the $1 billion revenue in 3 years.
Yeah, I probably did a poor job of explaining the difference between the bottom up and the top down. In the top down model, you're not really connecting the dots. You're not really saying, okay, year 1, I'm going to hear this in expenses. Year 3 will be here in revenue, and that needs to be $1 billion. No. What you're trying to do is just show the market opportunity. It might take you 5, it might take you 7, it might take you 10 years to get there. And generally, a venture investor is going to have a 7-year time frame to 10-year time frame. So you don't have to get there in 3 years. So when you're looking at the top down, there's not really a time frame attached to that. It's more, what's the opportunity? If we achieve all our objectives and we get to everywhere we want to go, how big can we be? Not so much as when we're going to get there. In back?
For a company without an operating history, really no way to understand what the revenue is going to be next year. I mean, do you just pick an average midpoint, knowing that it's likely to be much higher or much lower? How do you even think about revenue?
Well, who are your customers?
Enterprise. Now, I can make up numbers.
Well, what's the competition?
There is some competition, but
What do they sell their products for?
private companies don't know. Oh, that's what are they selling for? I know how much they sell for. Also, we know how well we do.
But that's not as relevant as actually. So first of all, you will be challenged as to who your competitors are, and there better be some.
And I can make up reasonable numbers. What we all know without an operating history is they're only loosely tied to reality.
But this is where your research comes in. So you're going to appear more on top of things to the extent that you can give an understanding of who your customers are. And Joyce is giving me the time out warning that she can get my attention. So anyways, you have to go out and see what the marketplace is like, because it's not just about you, it's who you're competing with. And so giving that kind of intelligence to the investors is going to be helpful. Okay, thanks very much. I appreciate it. I'll be here after the seminar ends, so if there are any questions I didn't get a chance to answer, come up and see me after.